Assalamu alaikum friends, welcome to day 7 of AFM 14 days revision crash course. So this topic, which is risk adjusted WACC and adjusted present value, is derived from our previous topic, that is WACC. In our previous topic, that is for day 6, we told that WACC cannot be used in a new project if the risks are different. If your business risk and financial risk are different, therefore you need to adjust them. Okay, so from there this topic came risk adjusted WACC, which we are going to cover in this. And this is also a topic that you are going to get most of the time. This question is asked. Okay, sometimes you might be given just net present value, sometimes you might be given adjusted present value in addition to net present value. Okay, so in this we are going to focus on past exam history, risk adjusted WACC and adjusted present value. In the past you have seen that most of the time this question can come anywhere. Okay, question 1, question 2 or question 3, but it comes in one of the question, so you have to be very well prepared for this. And this is an area, mostly this is calculation, so try to get as many marks as possible from this question. And because calculations are heavy on this topic, it's very easy, the students can often make mistakes. Okay, so when you are using your Excel calculation, you need to be a little bit careful. You need to check or maybe recheck whether your workings are right or not, because every answer is dependent on the other. Okay, the moment you make mistake somewhere, it will be carried forward. You understanding? So, and there are lots of questions that you need to do, and especially if you get this question as a question 1, you can expect the length of it. It will be, the work will be double. You need to do lots of calculations. Okay, some of it will go to adjusted present, sorry, some of it will go to net present value calculation, like normally how you do sales, the cash inflows, deduct cash outflows, discount them, then net present value, then comes the adjusted present value. There also you have workings. Okay, so risk adjusted WACC, it means when your project, new project, has a different business risk to your existing project, you have to adjust your asset beta. Same for the equity beta. When your financial risk is different, you have to adjust. Okay, so in this case, you cannot use the existing WACC, you have to change the WACC, adjust the WACC. Hence, risk adjusted WACC. Okay, these are some examples. Okay, let's say Y is a boat building company with a DE ratio. D means debt to equity. Debt is 1, equity is 3. Okay, 1 is to 3. They wish to evaluate a fashion industry. They are in what industry? Boat building. They want to evaluate a project in the fashion industry. Automatically, risk is different. But business risk is different, definitely. We don't know about finance risk yet, but business risk is different. Because Y is in the boat building, they want to evaluate a project in the fashion industry. It's a different industry. Different industry means risks are different. Okay, but does not intend to change its capital structure. That means the finance risk remains the same. So you only have to worry about asset beta. That is different. Equity beta is same. Okay. Suppose X is a typical fashion company. Why? Because you want to evaluate a project for which industry? Fashion. You need a similar company to fashion industry. Proxy beta. So typical fashion company, let's say X, has an equity beta. They will always give you an equity beta. Proxy equity beta 1.3. Okay, so you have an equity beta of 1.3, and their debt to equity ratio is different, 1 is to 2. Okay, what do you have to do? And you have been given further information: risk free rate 6%, RM 14%, tax 30%. Debt is risk free, that means debt beta is 0. Debt beta is always 0. Okay, even if they don't give it as an assumption also, it's 0. Now you need to calculate a discount rate using this information. How are you going to start? I told you, always start with the proxy beta, equity beta, that is 1.3. Adjust it. D gear. First D gear. Remove the impact of their gearing, that is 1 is to 2. Then add your 1 is to 3 in that. So this is what you have to get. First get the asset beta. You are given equity beta. So next is always get the asset beta. For what? Not for Y. I agree your company is Y. At the end you have to get for Y. First you have to get an asset beta for X. This is how you get it. Using the ratio of X only. You cannot get X asset beta using the gearing ratio of Y. No, it has to be the same company. If you are finding the asset beta of X, you have to use the gearing ratio of X only. So the formula is there. You don't have to write the formula because the formula is already there in your exam formula sheet. But in your Excel, you have to do this. So the moment examiner clicks your cell, they can see this formula there. That you have multiplied asset beta with 2 divided by 2 plus 1 into 1 minus tax. Okay, so 1.3 is your equity beta. Multiply by 2. What is this 2? 2 is the equity. Divide by again 2, which is equity, plus 1 is your debt, into 1 minus 0.3 because tax is 30%. And you get final answer 0.963. Hold on. You first need to check this with your equity beta. Is it more or less? You see equity beta of X is 1.3, asset beta is 0.63. Technically it is right. Numerically you might be wrong if your addition subtraction wrong, but technically you are right because asset beta is less than equity beta. It should be 0.963 is less than 1.3. If your answer was more than 1.3, you definitely know you have made a mistake. So this is how you check. Now using the 0.963, you de-gear. That means now you are finding equity beta of Y. Okay, that is called gearing up or re-gearing. So this is what you do. You just change the equation. Same equation. That's only. But you just change. Because this time you are making 0.963 asset beta the subject. Okay. You make that subject. But you have to find equity beta, right? So first write it. This time you are using the Y's gearing 3 is to 1. That's why you can see 3 up. Everything else remains same. And you are getting 1.188. It has to be more than 0.63 because it's an equity beta you are finding. Now using this equity beta, third step, put it in your capital asset pricing model. Multiply it with 14 minus 6. 14 is your risk RM, risk free is 6%, and plus risk free which is 6%, which is 15.5%. Now in your exam you have a choice. Either you can keep it as 15.5% or you can keep it as 16% also. You can round it up as a whole number. It's your choice. But I always say rounding it to the whole number is always good. Okay, advisable because it's easier to work. Because you can easily get the discount factor from the table. Like if you have 15.5%, it's difficult. You have to manually do that in Excel. But if you keep it 16%, you can easily use the discount factor table to find the discount factor for various years. Cost of equity is over, cost of debt you need. That is simply 1 minus tax. So your risk-free rate is 6%. Just take 1 minus tax, which is 4.2%. Now, WACC. What is your debt? Sorry, what is your equity? 3. Debt is 1. So 3 plus 1 makes 4. That means 3/4 is your debt. 3/4 is your equity, 1/4 is your debt. So 3/4 of cost of equity plus 1/4 of debt, that is 4.2%. That's it. You don't have to minus 1 minus tax again. Because already when you have taken KD in the fourth step, 6 into 1 minus 0.3, you have already deducted the tax. Don't do it again in WACC. That's how you got 4.2%. Or you can do it in one go also. 1 over 4 into 6% into 1 minus 0.3. It will give you same answer. So the final answer is 12.7%. That's your WACC. Now, if you can recall from my previous revision videos, I think it was introduced in day 3 or 4. I told you that according to the theories, we study some theories, remember? Static trade-off theory, pecking order theory, MM plus theory. So according to that theory, your WACC will always be in between your cost of debt and cost of equity. Can you see it here? Yes. Cost of equity is 15.5. WACC is 12.7. Cost of debt is even less, 4.2%. You understanding? So that means the model works. Okay. Now, the project needs the same financial risk as the company for the discount rate to be appropriate. Remember, to use this 12.7% as a WACC, even your financial risk has to be same. It overvalues the tax shield where debt is finite, as assumes debt is perpetual. Okay. Issue cost on equity are ignored. There are some things which are ignored. Issue costs are there for debt, sorry, for equity, which makes equity even expensive, but that is ignored for this purpose. And this also overvalues the tax shield only where debt is finite, as it assumes that debt is perpetual. But you cannot always take the advantage of tax shield on debt forever. It doesn't happen. But this model, it overvalues. It says no, having debt is good. It overvalues. Now we are coming to the most important thing, that is adjusted present value. This takes three-stage approach. Number one, project is evaluated. That means you are finding net present value. Stage two, your finance package is evaluated. This is the tough stage. Okay. And stage three, add stage one and two and get your APV. If APV is positive, accept the project, otherwise don't. So in stage one, you first need to find the asset beta. Asset beta. Why? Because in project one, remember, even if it's net present value, this is not normal net present value. You are assuming everything is equity financed. That means no debt has been used. Everything is equity financed. So everything is equity finance means no debt. No debt means no gearing. No gearing means only asset beta. Asset beta measures asset beta or ungeared, you can say, right? It's not geared, ungeared. There is another word for asset beta, ungeared. So that's why you're finding asset beta. Then remember, in your capital asset pricing model, you use equity beta. Normally, here you are going to use asset beta. Only for APV, you use asset beta because you are assuming it is ungeared. Total equity you are using. So stage 1 is total equity, stage B is debt, stage 3 add equity and debt. Okay, that's what you are doing. So then you get a discount rate. And then you use that discount rate to find net present value, base case net present value. This is an example. You can even write it while I'm explaining this. Let's say you want to evaluate a telecom project, and Z is a quoted telecom company with an equity beta. Gearing ratio is 1:2. Tax is 30%. Now you need to find asset beta. Just use the formula and find the asset beta. Okay. Now use this asset beta in capital asset pricing model, where tax risk-free is 7%, market return is 15%. Okay, and get it. This is as simple as that. Now this only you will use to find your base case net present value. This 12.9 or you can is 13%. Now stage 2, a project will be financed. It could be financed in various sources of finance. You might be given return earnings, loan, bond, subsidized loan, or it could be there could be various ways. Okay, let's say 1 million of it is financed through retained earnings, another 2 million right issue, 4 million by subsidized loan, and 2 million by a bank loan. And you have been given the administrative cost, that is 5 5% of the finance raised. And the bank loan involves 60,000 arrangement fee. Tax is 30%. To solve this, okay, you can put it in a form of table also. Okay, in your Excel you can do all this. Please use Excel to do calculations. Okay, you just have to find the present value of all this 1 million, 2 million, 4 million and 2 million. Okay, so let's start. First, it is the admin cost. What is the right issue? What is the amount for right issue? 2 million. And they said that it is the 5% of the finance raised. Remember, most of the students go wrong here. What do? They put 5% of 2 million. That's not what you're supposed to do. It is 5% of some amount that is raised which is equal to 2 million. So, so in order to find that how much of it is right, sorry, the administrative costs that is involved, you need to find it like this. 2 million into 5 divided by 95. Okay. If it was 7%, it would be 7 divided by 97. The denominator will always be, you have to deduct it from 100. That's why it's over 95, not over 100. So 195 into 5. Because you want to find the cost, admin cost, which is 105. Okay, this is how you always do. Suppose it was 3%, then it would be 3 divided by 97. 100 minus 3. Okay. It's always like this, so you don't have to worry about it. You can even memorize it if you want. The formula. Timing 0. You don't have to pay it for all the years. So discount factor will be 1. If you see here, discount factor is at 10%. Why? Let's go back. Because you can see that you can use any discount factor. They have taken the discount factor at 10% because that is what the bank loan is. It's at 10%, which is debt, right? So you can use that also. But you have to give your assumption. Which discount factor are you using? Okay. So here they have used 10%. Present value is 105. Next is loan arrangement fee, which is 60,000. Okay. This is one time payment. Discount factor is 1, so it will be 60. Next is bank loan. Remember, when you are paying bank loan, you are paying interest. You are getting tax relief on that interest. That is how many years? 3 years. So amount of loan is 2 million. Interest is 10%. And tax on that is 30%. So 2 million into 10% into 30%, which is 60,000. This will be paid over 3 years. That means first year, second year, third year. So the discount factor, if you take the annuity factor, because you are paying the same cash flow, right? 60,000, 60,000, 60,000. So you can use the annuity factor if the cash flows are same. That's why you're using the annuity factor 2.487. You can get it from the table, annuity factor table. Okay, 3 years at 10%. If you have to find the annuity factor, you have to first find that it's at 10% and then 3 years. You will get 2.487. So multiply 60 by 2.487. Present value will be 149. Next we have subsidized loan. Subsidized loan means interest will be lower than the normal loan. Normally it's 10%. Subsidized loan is giving you 4% loan. And the amount is 4 million. So on that 4 million, 4% and 30%, which is tax relief. 48. Same 1 to 3 years. Annuity factor will be same. And it will multiply. Then we have subsidized loan. Remember, because you have a subsidized loan means now you have to pay less interest. So you are saving on the interest. How much? The difference between the actual loan and the subsidized loan. Actual loan is at 10%. Subsidized loan is at 4%. 10 minus 4 is 6%. You are saving 6%. So on that 4 million loan, 6%. 240. But this is also 1 to 3 years. Annuity factor will be same. Multiply annuity factor by cash flow and get it. Then we have tax relief lost. Because you are saving interest, that means you don't have to pay interest. That means you are losing that tax relief also. So it's like an outflow. 4 million is the loan. What is the amount of subsidized? What is the amount that you have saved? 6%. Now take 30% on that because that is the interest that you are giving up. You cannot save. Like you cannot take the advantage of that tax relief because you are paying less interest. 72 outflow. That's why it's in bracket. Outflows are always in bracket. In your thing, you can put it as minus 72. 1 to 3 years, annuity factor will be same, multiplied, and 179 is an outflow. And finally, add all the present value. Minus 105 minus 60 plus 149 plus 119 plus 597 minus 179. Put it. You can take the sum function in your Excel and get this answer. Or you can use a calculator. You should be able to get 521. And if you see, this 521 is a positive figure, right? Stage 3, add both net present value and the second step. So let's say base case is 5. Sorry, if you see net present value is negative 10, but the present value of the financing side effect is plus 15. So overall is plus 5. Now what's happening here? Imagine if you just take the net present value, the disadvantages is that you would have rejected the project, right? Because it is giving you negative net present value. Based on that, you will reject. But if you add the financing side effect also to it, now it becomes positive plus 5. So now you will accept the project. That's why adjusted present value is very important to base your decision. But remember, APV is not given all the time. Sometimes it is just net present value. If APV is not given, do not worry about it. Do not find all these things. Sometimes with net present value, you might be given real options. So the question, it matters on the question, to question, whether it is APV or real option or just net present value. If it is APV, how will you understand? If the question does not say to find adjusted present value. It is very easy. You will find information like issue cost, subsidized loan, government subsidy. You will find these terms there. Okay. Now the key questions that you need to uh, raise. Is the finance dependent on this particular project? Like, do you need a development loan? Or, see, these are for writing purpose, okay? Sometimes it's just not calculation. Sometimes you might have to write for 10-15 marks. Only writing. So you should be able to write also on this topic. Adjusted present value. It is just not the calculation. Are there any better projects available that are not currently being undertaken because of capital rationing? Okay. Capital rationing means your finance is limited. So because of that, are you not able to take any better projects that are currently available, but because of finance you are not able to take? These two questions you need to raise. Okay. Now let's go to debt capacity. Debt capacity. What is debt capacity? What is a debt capacity? You need to understand what is debt capacity. A project's debt capacity denotes the project's ability to act as a security for a loan. Okay, debt capacity is like how much of your debt can act as a security. If you're having a debt capacity, let's say 60%. Okay, a 10 million project has a 60% debt capacity. That means as your project can add as a security for a 6 million loan. That's what it means, 60% of 10 million. Okay, example. Suppose there are 3 different finance packages and you need to choose. Let's say package A, 6 million of debt, 4 million of equity. B, same. C, debt is more than equity, 7 million debt, 3 million equity. Now, package A, where you had more equity than debt. Okay, that means A fully utilizes debt capacity. Why? Just see A, 6 million of debt, 4 million of equity. Equity is less, correct? Entirely they have used their debt capacity, isn't it? Debt capacity they have utilized. That means the project is fully geared. Why? Because debt is more than equity. Debt is more than equity. Package B, Package B, let's say, sorry, they are not looking the figure. This is their debt capacity they are giving. Okay, this is not based on the figure. Sorry, I'm sorry. Project A utilizes full capacity. Project is fully geared. B underutilizes. That means debt capacity is something, but they have not utilized it entirely. They still have something. So the project is undergeared. That means they still have 1 million of unused debt capacity, which they can use. That means they can take 1 million of debt more. C fully utilizes the own debt capacity plus 1 million of another project's debt capacity, also spare debt capacity. Maybe that project didn't use that. So they have used it here. So this project is overgeared. Which one will you take? In the APV analysis, okay, the present value of the tax relief on interest should not be calculated. Present value of the tax relief on interest should not be calculated on the basis of the actual amount of debt. Not on the actual amount of debt, but on the debt's capacity of 6 million. So it depends what is your debt capacity. Based on that only you will calculate, never on the actual debt. Why? Why? Because tax relief on interest, or you can say tax shield, is valuable, and to avoid a cross subsidization of one project with another project's debt capacity, so that you are not using one project's debt capacity for another. There is not a cross subsidization. You are avoiding it. That's why it is not on the actual amount of debt. It's on the debt capacity that you are taking the present value. If you are not able to understand the theory part, at least through questions, calculations, you will get it. Try to do question where you have a debt capacity which is equal to your actual debt. Then calculations involving debt, any debt, must take account of the tax effect. Do not forget this. There could be one type of debt if you are lucky, but sadly to say, it's not only one type of debt. You will get 2-3 types of debt, and all the debt will have tax effect. Make sure you work out, okay? Because all debt has tax, has interest, and there will be some tax effect. And what about debt issue cost? Equity issue cost, we know it has nothing to do with tax, but debt issue costs are tax deductible, often with a 1 year's delay. They will write it whether it's 1 year's delay or in the same year, but they have. But equity issue costs are not tax deductible, meaning if there's a debt issue cost, adjust it for tax. Equity issue cost, do not adjust it for tax. Okay. Now there are some practical problem with this approach. Number one, you are de-gearing industry beta, right? You take some beta, de-gear it to get a beta. For what? For an all equity firm, assuming everything is equity finance. But that does not include any market imperfections like bankruptcy cost. What about it? You do not include it there. So it's imperfect. It's a problem. Number two, the discount rate that you have used to evaluate the various side effects can be difficult to determine. There are various finance that are used, and just using one discount rate, no, it's not easy. Three, in a complex investment decisions, this calculations can be extremely long. This APV. Imagine there are 5, 10, 20 types of finance that you have used. It's difficult, right? But the advantages is any tax shield on any size of loan, everything can be incorporated in this APV for any duration with any type of repayment structure. APV will look into it. Second, the M&M's theory says tax relief on interest, debt interest is risk free. Okay. APV can easily handle problems of changing capital structure. If you are changing your capital structure, debt to equity, debt 30%, equity 40%, like if you are changing that ratio, APV can easily handle that problem. Then we have APV is useful for valuing any type of financial advantage. Any source of finance you use in any way, APV is useful for that. Make sure that you know some advantages and disadvantages of this model because you have to write. So that's it for this. Next we have option pricing. Again this comes in your net present value. It can come, okay, and this is mostly calculations. This has a model, you need to memorize it, okay, and it's one of the easiest. So thank you for watching, and do not forget to subscribe to my channel if you haven't. Please keep practicing lots of questions on net present value, adjusted present value, and see you in the next video.